Are the dollar bears about to roar? Hi, everyone. Welcome to the Real Vision Daily Briefing. I'm Maggie Lake, and with me today is Brent Donnelly, president of Spectra Markets and a partner in the RV Marketplace. Hi, Brent. It's great to see you.
Hey, Maggie, it's good to be back.
So, we got a lot to catch up on because you and I haven't talked in a little bit. And we've, once again, sort of had a lot of volatility around what's happening with the Fed, what's happening with the economy. We saw stocks rallied again today, at least early on. I haven't checked in the last few minutes, which is important because things have been changing, but generally a pretty good tone. Bond yields down, staying down, US dollar lower. And it's really a continuation of that move we saw in the wake of the weaker than expected non-farm payroll number and a pretty dovish Fed. But, there's a lot of churn underneath that. And I think a lot of debate still. So let's start big picture. And what's your view of what's happening with the US economy and rates?
Sure. So there's a lot going on, like you said, and we've been in this regime where everything lasts for about 2 or 3 months and then things change. So we came into the start of the year with yields on the lows, I think 6.5 cuts priced. And now the pendulum has gone wild the other way. And that's been on the back of strong data, but then also on the idea that maybe the Fed could even hike because rate hikes haven't been doing enough. And I think that pendulum swing has gone a little bit too far now. So what I feel like is we've gone all the way from 6.5 cuts to 1.5. But I think the modal outcome now, if you ask people, is probably like higher for longer and no change this year. To
Oh.
me, that just seems too far, especially with the Fed. But starting with the data first. So the last little ramp in yields came from employment cost index and some prices paid on the ISMs. And to me, that's kind of backward looking. We had this little reflationary boom kind of thing that happened over the last couple of months with commodities. And then we had the Middle East. You had copper ripping, global manufacturing looked a little bit better. China's been good. But those are all things I think that are a little bit in the rear view.
Mm.
And to me, now the interesting thing is we're seeing quite a bit of softness in the US data. Now, not recessionary by any means, but much less stonking. So the pattern has generally been that economists have just underestimated almost everything over the last couple of years. So it's been rare that you see a string of worse than expected data. And I don't know if you want to get into it right away, but the most interesting thing is what's happening in the soft data.
Yeah, let's talk about that because I think I think you just laid out perfectly where some of the it's not really confusion. It's just people seem to be zigzagging, right? You sort of get a narrative and you have data that people point to, and then you're getting these other reads that seem to say something different. And that has been the case, but people I think are confused about what to look like. So what are you seeing and what do you mean by soft data?
Well, also just before I talk about that, one reason that people have been confused is that the Fed has been changing direction a lot. So
Mm.
we were in a hike cycle, and then they basically rolled out the mission accomplished banner, a la George Bush 2003, with Waller's speech at the end of 2023. And the problem was that the mission wasn't accomplished. So they made an assumption by extrapolating the CPI and PCE data and said, okay, good, like we're done. Now we're ready to cut. And the dots started pointing to cuts. But the problem was that whether it's reflexive or not, so part of the problem with inflation rebounding was probably specifically that the Fed went dovish last year at the end of last year. But then at the same time, they just didn't wait for the fire to be put out completely. So it's like when the doctor gives you that penicillin prescription or whatever, and they say, even if you feel better after 7 days, you got to take it for 10 days. And what the Fed did was they took it for 7 days and things felt better, and then they stopped taking it. So they took their foot off the brake, and then animal spirits came back and inflation came back. So that I think is one of the reasons why people have been confused is that historically, most of my career, the Fed has run with a forecasting framework. So because of long and variable lags, they can't just set policy based on whatever the data is right now because their policy takes 12 to 18 or maybe more months to play out. So if you're just setting policy based on current data, you're always going to be lagging. And so now, because they don't really seem to believe in their forecasts anymore after so many mistakes, like in the transitory one, obviously being the main one, where they were still buying assets in 2022 when inflation was at 7% or something. So because of that, they're not really using a forecasting method anymore. And so they went super dovish in November. Now they're going super hawkish again, saying, well, actually, no, cuts, maybe not. And so I think that's contributing to the volatility and the confusion. Whereas if you just had a Fed that was saying nothing and just spoke at the meetings, honestly, I think that would be a much better communication strategy instead of having 18 governors and board members all saying different things all the time. But anyways,
Yeah.
that's neither
The
here nor
good
there.
old days. The good old days
Yeah.
when hardly anyone spoke, and the one who did, no one could understand.
Yeah, when Greenspan just said blah, 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 and you didn't really know what he said. So one interesting part of this cycle is generally the model is the survey data always turns before the hard data being like the real economic data that like industrial production and jobs and all that. And so when the soft or survey data comes in weak, then you can extrapolate about 6 months later, the hard data is going to be weak. But this cycle, that has not been the case. There's a bunch of reasons. The main one on the consumer side is that high inflation is bad for sentiment. So you saw sentiment collapse in 22 and 23, but high inflation isn't really bad for nominal growth. It's actually kind of good for nominal growth. So that creates a divergence where sentiment's in the toilet, but nominal growth is still good. And then on the business side, everyone was worried about this Bigfoot recession that everyone was kind of trying to find, but never quite found. And people were worried about rising rates, as you know, they probably should have been, because logically that usually hurts the economy. So business sentiment was very bad as well. But then for whatever reason, this cycle's been different. And the reason mostly is that consumers and businesses locked in at low rates before rates went up. So those two things were kind of making this weird situation where the hard data was good, nominal growth was good, retail sales, jobs, everything was good, but sentiment was horrendous. So then horrendous sentiment kind of came back and inflation went down and sentiment got a little bit better. But now the sentiment's getting bad again. And so now, but the funny thing is everyone's saying, sentiment data is BS, it doesn't work anymore. But I think that's ironic because now I think it probably will work because the inflation shock has subsided enough that sentiment shouldn't really be driven by it. And we're not worried about Fed hikes anymore. So I think it's more likely that negative sentiment is probably reflecting that demand and confidence are lower than they were, say, 4 to 6 months ago. But now everyone's ignoring it because it's like the boy who cried wolf. But in this case, I think it's actually meaningful. And then you compare that. So if it is meaningful, like if I'm right, which I may or may not be, then you look at the starting point or the entry point in yields, and yields are priced for perfection basically because you have almost essentially no cuts now. So I think there's a lot of room for yields to go lower if this sort of turn in the data proves to be correct. Now, non-farm payrolls is hard data, and that was a little bit on the soft side. So that's one step in the right direction. CPI really is the more important figure. And if you look at what commodities and things have been doing, they bounced back in the last few days, but overall, commodities are no longer adding to inflation pressure right now in the short run. So I think that helps too. So I think we're entering a little soft patch here, and that's why I think the dollar is probably going to trade weak from here, and I think bonds will do okay.
So it's interesting why it's interesting to think about it that way, but do you worry that if the market swings around and has a sense that they start putting more easing back in the forecast, that it doesn't just sort of, once again have the effect of stimulating the economy? Or has that maybe, fiscal support or some of the other supports that were keeping it revving so high, have they dissipated? Why wouldn't we just see this cycle that every time the Fed turns, the kind of financial markets take off and just create this repeat of reinflating the economy?
Well, there's two different scenarios. So one is they turn in the face of strong data when the data is still strong. And that's what we saw in November. And to me, that lights animal spirits big time because then it essentially makes people say, oh, I guess the 2% target is more like a 3% target. And that's inflationary, right? So that's the Fed, whether it's a policy error or not, it's the Fed's being dovish in the face of strong nominal growth. And that is like buy anything that's not nailed down because that's a debasement trade. But if the Fed is going dovish because the data is turning, then it's more like 2019, where they tightened and it took a while, and then eventually the data turns. And to me, that's just a completely different trade because then they're responding to weakness in data, and that weakness in data usually has a momentum of its own. So if you have strong data and they're easing, that's one scenario which we've seen for the last 4 months. But weaker data and them easing, to me, is a different scenario that doesn't necessarily mean that reflation just comes back, because you have the combination of the easing, which is stimulative in theory, but the fact that it's reacting to weaker data means that that weak data is going to play a role as well.
That's really interesting. And it's going to mean that all of these data prints are going to be really important as it kind of starts to shape this narrative. Bonds have really been setting the tone for equities. Is it also true for currency markets? Is it all about
Absolutely.
where that rate direction is?
It's kind of two things. So it's a combination of the direction of yields and then the volatility. So,
Mm.
like in 2022, we saw a very volatile bond market with rising rates. And that's a scary thing for equities. Like, what equities don't want is uncertainty. But now the cone of uncertainty is a lot narrower. So even when yields go up, now I don't think it's as scary because you're not really entering into a world where the Fed's going to go 75 is going to hike 75 basis points at the next meeting, which is where we were in 2022. And the interesting thing too is that another reason why I think yields probably top out now is that Powell had a chance to kind of put the hike possibility or the hike side of the distribution on the table. And he was like really skillfully managed to not do it. Like when people were like, what are the conditions under which you would hike? He would respond something like, well, let me tell you about some conditions under which we would cut. And, he basically just batted it away in a pretty good way. I think he must have rehearsed, he must have done some role playing before that meeting. So I think that reaction function also shows you that the bar is just at this point with the pricing here for pricing to get even more hawkish, the bar is just incredibly high. Whereas to go from 1.5 cuts to 3 cuts or 4 cuts, that bar is incredibly low. So you get a weak CPI coming up, and I mean that trade is very asymmetric, I think, because it's just so much easier to price in a couple more cuts. Whereas crossing that zero bound of going from cuts to hikes, that just requires like almost some kind of like, it has to almost look like an emergency for them to do that.
Yeah, that's so interesting. So the dollar has been, as we mentioned, coming under some selling pressure in the last few sessions. Does it feel where's sentiment now? Does it feel like there's more room to the downside now that people kind of see this potential shift, or do traders want to see more data? How does this look like it's setting up?
Yeah, we're kind of in this purgatory right now because the market. So we have a measure of dollar sentiment and dollar positioning, and it was the most long. Both momentum and positioning were the most extreme long since October 2022. That was April 15th. So that's about 3 weeks ago. We got to like max record long dollars, and the market just doesn't move. Like positioning just doesn't change that fast. So now you have a situation where CTAs are still max long dollars. Specs are kind of like, they've reduced maybe from 100% to 50%, but people are still kind of praying for this long dollar trade to work. And there hasn't been enough negative data. So what I'm describing is kind of like I see weakness and I'm forecasting that it continues or gets a little bit worse, but it hasn't been bad enough for people to say like, okay, the crap's hitting the fan, I got to be short dollars. So we're kind of in this weird in between where I believe like the macro narrative has changed from everything's amazing in the US to maybe slightly amazing, but not as amazing as it was. But it hasn't, the narrative hasn't turned enough to actually impact positioning. So to me, that's kindling for a big dollar down move. But to get that dollar down move, you're going to need to ratify this sort of string of weaker data with some actual weak, ideally inflation data, because
Mm.
in the end, it's the inflation data that matters the most. And even though I said, okay, the Fed was dovish and this and that, in the end, it doesn't even matter that much what they say because they've been so beholden to the 3-month annualized data, which again, like I said, I think is a mistake because you end up chasing your tail doing that. But that's what they're doing. So to me, it comes down mostly to the CPI data. And then, of course, like the inputs into that, some of which are transparent market prices, like the price of oil, which to me is not traded well through the Middle East stuff. Even though that stuff calmed down, oil traded horrible, even when that was a pretty scary situation in Iran and Israel actually attacking on each other's soil.
Yeah. Yeah, that was a lot of people were a little bit surprised by that. But again, it's just showing so many cross currents, right, in these markets, and the commodity markets are included in that. I want to talk a little bit about the yen because there's been a lot going on. I know that you've been talking about it and writing about it, but where are we now with that? Right, it hit multi-decade lows. Talk of BOJ intervention. You yourself said, yeah, they're intervening, but not with the sort of conviction maybe that you would expect if they really wanted to make an impact. What's happening with the yen right now?
Right. So there's a lot of pieces to this. The main one being the dollar. So generally, dollar yen is almost always, or always throughout my career, starting in the 90s, it's a yields trade. So if yields are going up, most likely dollar yen is going to be going up simply because you can own dollars and be short yen and make the carry. And that's an attractive trade. And especially when volatility is low, that's always going to be attractive. So ultimately, the Ministry of Finance, by intervening, can't really change the direction of dollar yen. But what they can do is they can halt the rate that it's moving or the speed with which it's moving. And so in April 2022, they intervened and then they got lucky and yields went down and dollar yen went down and that was it. And so generally that's how FX intervention works is like even when you saw Brazil intervening in at other times or whatever country intervening, usually they're not trying to reverse the trend. What they're trying to do is avoid disorderly depreciation of their currency. And then they just have to hope that FX fundamentals turn at some point. But it got interesting over the last couple of weeks because just to give like a really quick background, I don't want to bore people with the history, but I think it's important to know that the Japan throughout history, throughout most of the last since 1990 and the Nikkei bubble burst, has had a problem with their currency being much too strong. So I think that's an important context when people are saying, "Oh, the currency is collapsing and it's weak." I mean, essentially, this is what they wanted. Dollar yen was at 75, and Abe introduced his platform called Abenomics. And one of the prime targets of that, there were three arrows in the quiver, and one of the arrows was to weaken the currency. So to say that they've lost credibility and the yen is collapsing and they're out of control is just completely wrong. They have tons of credibility. In fact, the MOF was buying dollar yen at 80, and now they're selling it at 155. So not that central banks or ministries of finance are motivated by P&L, but they have a lot of credibility. They've devalued their currency in a pretty controlled way, and now they're saying enough is enough. And I think the thing that people forget is that so the main issue with Japan is that monetary policy is very loose. So they're fighting that. The Ministry of Finance is essentially fighting the BOJ in a way, which is makes it difficult. And that's the trilemma. If anyone wants to Google the trilemma, but then at the same time, they do have other things they can do. For example, they can change tax policy to make it more beneficial for Japanese to repatriate yen, which is something they've floated. And in the end, unless you think US yields are going back above 5%, I think it's not a good bet to be short yen because what the Ministry of Finance does is they truncate one part of the distribution for a while and then eventually they give up. But they generally, I think speculators will give up before the Ministry of Finance. And just one last thing, I don't know if we can put up a graphic for a second, but I'm a big into behavioral things like magazine covers and people freaking out and making crazy price targets and stuff. I think because my experience in the dot-com bubble was every time someone makes a price target that's insane, that's usually the high for the stock. And in the last 10 days or so, there's been so many of these sort of behavioral things with the yen, people saying it's going to 200. We got an Asian currency crisis. We're rerunning the 1998 Asian financial crisis and things like that. And it's like when the Chiron on CNBC says markets in turmoil or whatever. It's just it's a behavioral clue that the emotion and the sentiment are at an extreme, and I think we hit that in the end. So I'm more biased to be short dollar yen at this point. But in the end, it's a dollar trade, and if you're doing that, you need U.S. yields to go down.
Have you been getting a lot of inquiries about that? Because we've had several different people come on recently, and they're very bullish Japan. That when you ask them where they see opportunity, that's what they're looking at.
Well, it's kind of two different things because a lot of people, when they buy Japan, they do it currency hedged because of the correlation tends to be if things are going well in the world and in Japan, then the yen weakens because of the carry trade and Nikkei goes up. So Japanese stocks have been super popular for sure. I think when we're in the period of US exceptionalism and there was an acronym TINA, which was there is no alternative. And it was like, all you can do is own Mag 7 and tech stocks because everything else is crap, was kind of the thesis for a while. And the first country that kind of was the exception to that was Japan, because Buffett made a huge purchase of Japanese stocks. And the way he actually did it was genius because he issued bonds in Japan at the super, super low yields in order to finance the purchases of the equities. And the equities have gone up, the yen's weakened, and the rates have gone up. So everything, all three legs of the trade have been pretty smart. And I think that started kind of like a surge of interest. And there's been a lot of interest in Japan just because it's cheap and it's a momentum trade as well. So, but you don't have to be bullish the currency to be bullish the stock market there. In fact, usually they move in opposite directions.
Yeah. Part of the reason I think people were, talking about whether there's an Asian currency crisis and concern about it is because we had the dollar strong against so many currencies and including the Chinese yuan, right? There was concern that there would maybe be something that looked disorderly or there would be a devaluation of the yuan. Is that something that you think is on the card? So if the Japanese are approaching it that way, what are the Chinese doing in regard to their currency?
So that's right. They tend to move together a little bit because obviously the dollar is the dominant driver of both. And I had referred to September 2022 when the MOF came in. And at that time, China was actually even more worried about their currency and the dollar than Japan was. And they intervened at 7.38 in dollar China, and they won as well because yields went down. And so Japan and China both won. So there are a lot of parallels. The one big difference now, or there's kind of two, but one big difference is that dollar China is not at the highs now. It's at 720 and the high is 738. So it's a little bit off the highs. But the other thing is that it's a really confusing argument because if you just looked at pure macro and China's an exporter, obviously then in that framework, they would want the weakest possible currency. But the thing is, they have many other goals. And one of those goals is stability. And another goal is to resuscitate the consumer after the real estate shock. So if you devalue your currency, you're creating instability and you're also punishing the consumer.
Hmm.
So to me, and then the last thing, actually, the third thing you can look at is just what are they doing, because it's a managed currency, it's not free floating. So they set a fixing, and then onshore it has to trade within 2% of the fixing. So the offshore can move around that, but the basis can only get so wide. So generally, it's kind of like a managed float kind of thing.
Yeah.
And they have been fixing at the exact same rate, plus or minus like 10 basis points for a long time. So what they're actually doing, forget about what they say, what they're doing has been signaling we want stability. We don't want depreciation, but we don't want appreciation. We just want the thing to flatline and keep consumers' buying power at where it is. But they also may want to be keeping it stable ahead of the election, because it's an interesting one election wise, because it's one of the few bipartisan things or policies in the US is everyone wants to bash China. So they also may be wanting to keep it stable in case tariffs are increased, because
Hmm.
generally their response to tariffs is to weaken the currency. That's the simplest way to offset. If there's a tariff for X, you can calculate what the currency needs to depreciate to offset the tariff. And during the Trump tariffs, that's exactly what they did. Is he put the tariff on of 10% and they would just devalue the currency by 3 or 4% to offset it. So I don't think that they're going to devalue simply because it doesn't fit their policy goals. I don't think exports and mercantilism are anywhere near the top of the list. I think consumer and stability are the top of the list, and mercantilism and exports are 3, 4, 5 kind of area.
So spot on about the consumer really being their focus, that domestic, they're very much concerned about keeping that domestic economy on track and focusing on trying to grow that part. Sam asking, what's your view on stagflation versus soft landing going forward? This seems to be the main split in narratives right now with totally different outcome for risk markets.
Right. So actually, do we have the chart of ISM? I think that's an interesting segue.
We'll see, Brian. Yeah.
So that chart shows the ISM, the headline figure versus prices. So you can see this is what I was talking about with the soft data, is that the trend line shows the relationship between growth, you could call the headline number growth, and then prices paid, which is the inflation index within ISM. And you can see at this level of inflation, which is 60, we would normally be at like 55, 58 on headline. And right now the headline's closer to 49. So that is kind of like weak, very weak form stagflation, you could argue. The thing is for me is that I think the inflation impulse that we've seen is dissipating. So if demand is kind of softening, commodities are a little softer, then and so the things that we saw like ECI and actually even CPI or the inflationary things that we saw in Q1, I think that's kind of like the last gasp. And I think we're going to start trending back down, not aggressively, but I don't think there's a strong inflationary impulse. I mean, a really simplistic way to look at it is just to look at what oil's doing, because so many cycles and even like the zigs and zags within the cycles, inflation is kind of led by oil, and then yields are also led by oil, and oil's just not doing anything scary at all, and neither are gas prices. So I don't feel like there's really an inflationary psychology. I think a lot of what we're seeing in wages is just laggy response to past price increases. So to me, I feel like we're going to go into more of like a stag disinflation, but but like I said, I think quite a bit earlier, I don't think this is anything that's pointing to imminent recession, but I think there is a lot of stuff under the hood. And the thing is, I'm not a huge fan of just looking under the hood all the time, because if the headline data is strong, I think you have to Occam's razor it and say like, okay, the economy is probably strong. But if the headline data is kind of turning soggy and under the hood has been soft for ages, then I think it's going to be more of like a contracting demand and weakening economy story. And that on its own will just lead to more disinflation. So I think we're entering kind of a disinflationary soft patch, and like 1.2 on ECI or whatever we just got on CPI, those are probably going to be the peaks for this little. And when I say like, I'm talking almost like the mini cycle, like I'm really thinking about Q2, because as you know, my trading time horizon is shorter. So I'm thinking about Q2 and maybe like into Q3, that we get softening inflation, softening demand, and back to rate cuts again.
Yeah. So let's finish out with risk assets. It's interesting today because we've seen some relief in stocks and stocks rallying, Nasdaq doing well, Bitcoin not though. That's down now, not significantly, but it's at about 63. How are you thinking about risk assets here? Do we see a divergence? Are those two markets still correlated? And is good news
So
bad news, or is you know?
yeah, if I'm right, it's good for risky assets, because you're going to see a cycle more like 2019 where yes, things are weakening, but actually in a way that's kind of what you want, because you don't want super tight zero slack economy. What you'd actually rather have is a little bit of slack, but not too much. And so what I'm seeing would be bullish risky assets. If you get really bad data, there will be, there is a point where bad news is bad news, but I don't think we're there yet. We're not, I mean, we're not even close to that. With Bitcoin, people hate when I say this, but I see it as a risky asset, very similar to the NASDAQ or to triple levered NASDAQ. It's a very high beta risky asset that has obviously some idiosyncratic qualities and maybe has a little bit of gold and a little bit of other features to it. But if you look at, if we can bring up that flows chart, so the most important driver of Bitcoin since January has been the flows into the ETFs. And that chart shows the net flows. I'm excluding GBTC because that's idiosyncratic. It's not meaningful. So if you look at that and you see when the thing was launched, the flows were pretty good. Then they got really good around mid-March. And not coincidentally, that's when the NASDAQ peaked. And then when the NASDAQ peaked, the flows peaked into Bitcoin and they actually went negative for a bit. And now with the dovish Fed and everything looking good on risky assets, you can see at the very far right that flows have come back in. And looking at the price action today at the close, probably there were more inflows into the ETF. So to me, I think you can have a broad view on risky assets and you can include Bitcoin as part of that. But I don't feel like it's it was idiosyncratic around the ETF launch, like October 23 to say February. And then once that sort of euphoria has worn off, which it has now, then I think that you can now bucket BTC back in with TQQQ or some kind of super levered risky asset.
Yeah, which I know you're right. Some people are not going to want to hear, but it's all about the price actions, but especially if you have a shorter term horizon, it's good to understand how it's going to trade. Brent, so great to catch up with you. Really interesting conversation. And I think we're going to start to get a lot of that data. We're going to have to pay really close attention because if we are turning, it's really important to know that. And as you pointed out, probably not fully priced into the market at this point. So great heads up. As we mentioned at the top, Brent's part of our RV marketplace. So I read his note every day. It's fantastic stuff. Go check it out and you can get yourself a discount if you are a member. But it's a must read for us. And just another programming note. If you haven't heard Raul talking, economic singularity is coming. He and I had an interesting discussion about it last Thursday. If you want to go rewatch, he says we have 6 years to make as much money as possible. So the exponentialist is really that focus on the long term. They've got Imran in there to help you risk manage. You can have a 1-day trial. It starts today, and that's where you could get it at Real Vision/The Exponentialist. Thanks, everybody. Thanks, Brent. We'll catch up with you again soon. Thanks so much for being with us. We'll be here all week, folks. We'll see you then. In the meantime, take care and good luck out there.